Hello and welcome to Erik Penser Bank. My name is Jonas. I'm head of asset management, and I will give you a brief outlook for the second half of 2022 and some probably thoughts into 2023. Now, when we start the second half of 2022 and coming back from the summer, we have to remember this has been a very volatile year in terms of paradigms. We are now trading our sixth big story, and when we talk about paradigms, we're talking about one variable that derives over 90% of global equity moves, both in direction and magnitude. We have gone through US political crisis in the beginning of the year, or risk. And then we had obviously the war that transformed into an inflation trade, and then we did the profit outlook, and then we're back to financial conditions. And as we're speaking, we are predominantly trading US daily macro data. And when we look into the second half of 2022, obviously US politics will be key. We have midterms in the US. Now, when we enter this year, and if you look at this slide that I'm presenting on the right-hand graph, you can see how political risk skyrocketed. It's inverted here. And that was the result of the event that occurred in the beginning of the second week of January, which is when Trump became more popular in national polls than Biden. By then, the market had to recalibrate expectations for the midterms. What if the US will in fact turn Republican in terms of the Congress, speaking both the Rep and the Senate? That was, of course, a little bit of a shock to the system. And as we moved through 2022, we can see that we all became accustomed to this. We all meaning the market. So when we look at US political risk and conflict now, we're actually at levels we haven't seen since the booming heydays of 2019, which is obviously a good sign, because then a shake-up of the Congress should be pretty much in the cards. Now, that's easy said, it's harder for the market to do, so we expect this to cause some volatility, but we don't expect a major setup to this. Now, if it was a presidential election, we can predict those quite easily in the US. We have models doing this by 85% hit ratio and 92% hit ratio. And pretty much the market is our guide to this. So we will update those going into the autumn and look at the validity or the probability of actually seeing this shift in the US. But as we move in and look into this, we have to take into calculation that we're going to have a split power between the White House and the Congress. So that's one big theme. The next big theme, we think, is this blockification. We are strong believers in that the world is not functioning in terms of a globalized world anymore. We have a European bloc, which is a little bit of the losing end for the time being. And we have a Asian bloc and a US bloc. Now, these graphs are written in Swedish, but the text on the graphs is in English, and I will explain what we're looking at. And pretty much the first thing that we want to take a hold of, that we will enter the second half with a fairly large exposure to Asian equities, specifically both Japanese and Chinese equities. The reason for that is the economic strength that we're seeing in Asia. We have to remember that as we're speaking now, June 2022, global real economic activity indicators are actually increasing. We know there's a lot of talk about recession, but again, talk is talk. Data is data. We trade on data, right or wrong. If you look at this, for example, if you look at Chinese high-frequency data, we see a nice little pickup. We see a little bit of a pickup in stimuluses and stimulus package going through China. We can also see that forecasts are picking up towards the official target. We think that's pretty interesting. When we rank about 500,000 of equity products out there, the Chinese equity market is a clear winner in terms of vol, skew, Sortino's performance. So we think that this has to be part of a portfolio going into the second half, i.e. Asian equities. Here we look at Chinese. The second thing that we want to keep in mind is the volatility of the equity market will be here, i.e. the third and big theme will be, will we enter recession or not? And we believe, and this graph is just highlighting how quickly high versus low, advance versus decline, bullish, bearish, and vol curve is changing, and that volatility will continue into the second half. And you can see we saw this huge sell-off from Friday's CPI number, and then we saw a huge recovery in terms of this underneath the cash flow data, so to speak, in terms of high versus low, etc., etc. We think that volatility will remain, i.e. we have to be accustomed to lean back a little bit and take a broader view on the equity market, because otherwise we're going to be whipsawed going in and out, which is just going to trigger trading expenses. That means we have to pinpoint the economy more right than wrong, basically. And what I explain on this page is that this is a leading indicator for the US built on 3,500 time series, it's aggregated into one time series. This time series we traded very successfully in late March, early April 2020, when we saw a clear V-shaped recovery. That was a great trade back then. And if you look at this right-hand graph and where we are in terms of growth levels, we can't really see a recession here going in. This goes out almost a year and a half. And that to us is a little bit interesting, because if we're stressed in the market and we're affected by the recession talk, and we might even sell off the equity market on recession talk, then we should go with the data and start adding equity risk. And as we're speaking right now, in around the 16th of June, that is exactly what we're doing. We have had a good run in our alternative space, where we are having a very good, actually positive and high positive returns this year. We are rebalancing that into the equity space. So in the beginning of the summer, now we're sitting here and talk, when people are stressed about recession, rate hikes, etc., we stay constructive. We look at data and we say we can't see the recession risk, i.e. we have to use the sell-offs in order to add equity risk. Obviously that can be right or wrong, but then we have to underline with more data than what I'm showing right here. So we have built our own equity risk scenario, and basically the fear in the market is that the rate hikes, which you can see in blue from the Fed, will cause the economic variables to pretty much turn south quite rapidly, and we're going to end up in a recession. So i.e. the blue should lead this darker line, which is an aggregate of a couple of hundred different macro variables in the US that we find statistically being quite important to explain equity moves and the business cycle. And we can see on the latest read here that we have for the next year about 12.5 percentage point of recession risk. It's not zero, but it is not larger than that either, i.e. we do not see a recession risk as a sort of core position within the portfolio. The risk, if we had that and the equity market start to bounce, is that, as you will see in the next graph, that the bounce, if you look at, for example, 1994, where we had a soft landing from the Fed, that the bounce in the equity market was very rapid. You will miss this move if you're not in the equity market to begin with. This is a move that came within just a couple of weeks, and to reallocate with the cost that brings, that's going to be a huge task. It's easier to use the region that we were in when the Fed started hiking to add, even though you're not going to probably be rewarded day one, you should be rewarded over time. Now, when we fast forward to where we are right now, in order to explain this graph, the dark line here is actually the Fed's own probability indicator for US recessions. And what's neat about this is when we invert it, you're going to have a good solid 2 years leading time frame for the equity market. That has worked great historically. And as you can see right now, we have a huge sell-off in the equity market, and you have falling probability of a US recession. i.e. for us, as being a little bit of a data nerds, we're going to use this in order to reallocate more money into the equity market and to average down basically in anticipation of the rebound. Now, it's very interesting to compare today's reading on this recession probability to what we had when we entered the pandemic. Because remember, the pandemic came in late Q1 2020. By then, we already had a 20, almost 30% recession risk in the US. So the sell-off that occurred then happened on top of a mature business cycle slowdown. The contrast to today is obviously huge. It cannot be bigger. And we think this is a great period, and you had similar periods in the past. If you look at 2012, for example, you can almost miss the rebound. It happens so quickly. So it's quite interesting. And we do realize that a lot of people are talking about recession, but we always end up with the data looking at, okay, where's the recession data? Yes, if you look at University of Michigan, it's very low. But then again, if you look at the conference board's consumer confidence measurement, it's quite high. So which one are you going to choose? It all depends on the questions that you ask to the consumers, which we think you should actually clear the data for, because otherwise you can be a bit tricked by data. Again, you can have a look at what happened in 78, 79. We have a sell-off, but the economy doesn't respond, etc., etc. So there are some interesting times to look at. And as a final page, we can really nerd ourselves down and looking at daily updated GDP models for the US, because this we think will be the big theme in the second half of 2022. On top of this, we hope for other themes in terms of we are exiting the lockdowns in China due to the COVID, and we might obviously also hope for a positive development in the war in Ukraine. But in terms of the themes that we can actually measure today, because we also have to remember that geopolitical risk right now is very low. It's actually on the historical average since the Second World War. We can see that on a daily basis, when we look at the current quarter and looking out at the next couple of quarters, we can't see negative GDP growth. And for us, these daily updated GDP models, which are spanning between 0 and some 4%, it's quite a big span. Which we admit it is. It's a very insecure market in that sense on how you actually make this math to work. We like to look at all of these measurements. But the positive sign here is that we do not see it negative. And we do also believe that Q1 in the US will be revised upwards. So for us, we're increasing equities, and then you can think, but that must be a bad trade, we must lose money. Well, the fact is that if we choose our strategies carefully, we can actually sit with a highly over-allocated portfolio to equities and not losing more money than our competitors that are neutral. That depends on which equities do you actually put into your portfolio. Let's say, for example, you have energy equities that we have, or you have South American, or you have lithium, or you might even have an overlay of short positions. You might do it all unhedged in dollars. There are means by which we can afford to carry this constructive view that we want to encourage people to think about and try to exploit, because it makes you hopefully better prepared for the future. So when we look into the second half, we're going to keep on tracking GDP developments every single day. We're going to keep tracking US political developments. We do have an election in Sweden. We don't think that's going to disturb the market too much. It's going to be a mishmash as per normal, but luckily the bigger, or the OMX30, for example, is more depending on US macro than Swedish, which is good in this circumstance. We will look at the continued Fed hikes. I haven't even spoken about that, but it's priced in the market. We know it's going to happen. It's going to roll on. And one theme that we haven't even spoken about here, but something that we have already argued and take for almost a given, is that inflation will start to roll over. Inflation has already started to roll over. Pricing expectations on consumers has been almost halved within the last month. We think those are all encouraging signs that also speak well for an overweight in equities going into the second half of 2022. But I stop there. Every week, starting from the late August, we will update these themes, focusing on US elections, GDP growth, what's happening in Asia, when will European equities start to compete on a global basis again, and we'll also keep a track on obviously on inflation and then continued Fed hikes. But I stop there, and we can speak for hours on this. But I should also mention that we still see dollar strength going into the second half, which is quite a big theme for us. But I better stop there, because otherwise it will be an hour before I manage to end. But I wish you all a happy summer, and we'll be back in the second half of 2022. Thank you.